Let's talk about something that often feels confusing and, frankly, a little unfair. Have you ever read a headline about a billionaire paying a lower tax rate than a school teacher and wondered how that's even possible? You might think it involves secret offshore accounts or illegal loopholes. But what if I told you the most effective strategy isn't hidden at all? It's perfectly legal, built into the tax code itself, and has a simple three-word name. This strategy isn't a secret cheat code for the rich. It's more like a different set of rules that apply when you reach a certain level of wealth. Understanding it won't necessarily help you use it today, but it will completely change how you see the financial system. It explains a lot about how wealth behaves the way it does. My goal on Invest Easy 101 is to demystify finance, even the complex parts, so you can see the whole picture. The strategy is called Buy, Borrow, Die. It sounds dramatic, but it accurately describes a three-part process. Now, it's crucial to be clear, this is a wealth preservation strategy, not a wealth-building strategy for beginners. It requires significant assets to even start. But learning how it works is like pulling back a curtain. You see why the path to keeping wealth can look so different from the path to earning it. A law professor named Edward McCaffrey coined this phrase decades ago to explain a quirk in the tax system. For years, many experts thought he was oversimplifying things. Then, a few years ago, leaked tax data proved he was essentially right. It showed that some of the wealthiest people in America legally pay a lower tax rate than many middle-class families. This isn't about breaking rules, it's about using them in a very specific, intentional way. Let's break down the first part, buy. This is where the foundation is laid. Instead of focusing on earning a high salary, which gets taxed immediately, the strategy focuses on buying assets that are expected to grow in value over time. We're talking about stocks in companies that reinvest profits instead of paying dividends, investment real estate, or even art. The key is that these are appreciating assets. Here's the critical tax rule. You don't pay taxes on an asset's growth until you sell it. This is called a realized gain. So if you buy a stock for $100 and it grows to $1,000 over 20 years, you owe $0 in taxes during those 20 years. Your net worth increases, but no tax bill is triggered. This is a fundamental difference from how most people experience the tax system through their paycheck. Now, think about the typical wealth-building journey. You work, get paid, and taxes are taken out right away. You then try to save and invest what's left. This strategy flips that. It says, acquire assets first, let them grow untaxed for as long as possible, and then figure out how to live off that wealth without ever creating a taxable event. The first challenge is obvious. How do you pay for life if you never sell your assets? This brings us to the second and most clever part, borrow. Once you have a portfolio of valuable, growing assets, they aren't just sitting there. They can be used as collateral. This means you can go to a bank or a private lending institution and say, I own these stocks worth $2 million. Will you lend me money against them? For the wealthy, this is a standard service called a securities-based line of credit. The bank agrees and you get a loan, often for a large percentage of your portfolio's value. And this money hits your bank account and you can use it for anything, a home, a car, living expenses. And here's the key tax point. Loan proceeds are not taxable income. The IRS does not consider borrowed money to be income. So you are accessing your wealth without selling and therefore without triggering any capital gains taxes. The terms for these loans are often very good for wealthy clients. Interest rates can be low, especially if you have a large, stable portfolio. And while you're paying, say, 4% interest on the loan, your underlying assets might be growing at 7% or more, so your net worth continues to increase even as you spend the borrowed money. This creates a cycle. Assets grow, borrowing power increases, you borrow more, and your assets keep growing. This might sound precarious. Doesn't the debt eventually become a problem? What about the interest payments? This is a valid concern, but the strategy is designed for the long term and for substantial wealth. The borrowed amounts are typically a fraction of the total portfolio value, and the aim is to outpace the interest cost. But the final piece of the strategy addresses the debt question in a startling way. That final piece is die. This isn't just a catchy word, it refers to what happens when the person using this strategy passes away. At that moment, a powerful tax rule called step up in basis takes effect. When heirs inherit an asset, its cost basis, the price used to calculate future taxes, is stepped up to its market value on the day of the original owner's death. So let's make that concrete. Imagine someone bought a stock for $100,000. When they die, it's worth $5 million. Their heir inherits it, and for tax purposes, it's as if the heir bought it for $5 million. All that growth from $100K to $5 million vanishes for capital gains taxes. The heir can then sell it immediately for $5 million and pay $0 in capital gains taxes on that $4.9 million of appreciation. So what happens to the outstanding loans? The heirs can sell a portion of the inherited assets with no capital gains taxes to pay off the debt. The rest of the fortune passes to them tax-free. The wealth has effectively skipped a generation of taxation. This is how family dynasties preserve wealth across decades. The cycle can then begin again with the next generation.
To see the power of this, let's walk through a simplified example. Meet Alex. Alex sells a business and has $2 million to invest. Alex puts it all into a portfolio of growth-oriented assets. For 20 years, Alex never sells, letting it compound. That $2 million might grow to $8 million. If Alex sold, the tax on $6 million in gains could be over $1 million. Instead, Alex uses a line of credit, borrowing, say, $500,000 against the portfolio to fund lifestyle needs. The portfolio continues to grow. Decades later, Alex passes away. The $8 million portfolio goes to Alex's children with a stepped-up basis. They sell $500,000 worth to pay off the old loan, paying no tax on the sale. They keep the remaining $7.5 million, having never paid a cent of tax on the original $6 million in growth. The scale of this in the real world is immense. Major banks have entire divisions for this lending against securities service. It's a standard part of wealth management for the very rich. The minimum to access the best terms is often in the millions. The system is built to facilitate this method of accessing wealth. This strategy highlights a core asymmetry in the tax code. It taxes income and realized gains heavily, but it does not tax unrealized gains, paper growth, or borrowed money. For someone living on a salary, almost everything is taxable income. For someone using this strategy, their lifestyle is funded by non-taxable loan proceeds, and their wealth grows untaxed. This explains a lot of those shocking headlines. When you hear that a billionaire paid $0 in federal income tax in a given year, it's likely not because they had no wealth or income in an economic sense. It's because their economic income, the increase in their net worth, came from unrealized gains, and they lived off loans. Neither event triggers the income tax. For regular investors like us, this is more of a lesson in how the system works than a practical to-do list. Very few of us have portfolios large enough to secure substantial, low-cost lines of credit for living expenses. For us, selling assets in retirement will likely trigger capital gains taxes, and that's something we plan for. But this knowledge is still power. It helps you understand why political debates about raising income tax rates on the rich often miss the mark. For the ultra-wealthy using this playbook, traditional income tax rates are almost irrelevant. Their wealth isn't touched by those rates. It also changes how you might view the stock market. A significant amount of stock owned by the ultra-wealthy is essentially locked up. They never intend to sell it in their lifetime. This can reduce the available supply of shares, which can influence prices. They are investors, but not sellers, which is a unique dynamic. So what's the takeaway for a beginner investor? First, don't be discouraged or angry. Focus on your own path. Your journey right now is about building wealth, not preserving a giant fortune. Your tools are tax-advantaged accounts like IRAs and 401ks, consistent investing in diversified assets, and avoiding high-interest debt. Second, understand the principles. The power of long-term, untaxed compounding is available to you in your retirement accounts. Letting your investments grow for decades without constantly buying and selling is a powerful strategy at any level. The buy part of buy, borrow, die is something we all strive for, owning assets that grow over time. Finally, see the whole board. Personal finance isn't just about picking stocks or finding a savings account with a slightly higher rate. It's a system with rules, incentives, and unintended consequences. The buy, borrow, die strategy is one of the most stark examples of how those rules can be applied differently at different levels of wealth. It shows that the American tax code, in its attempt to avoid taxing unsold assets, has created a powerful engine for preserving intergenerational wealth. For the average person, this might feel distant, but as an informed citizen and investor, understanding these mechanics helps you make sense of the financial world you see in the news. Your strategy is different. It's about diligence, patience, and using the tools accessible to you. Max out your employer's 401k match, fund your IRA, invest in low-cost index funds. These are the proven, accessible steps that lead to financial security. The strategies of the ultra-wealthy are a fascinating look at a different game, but they don't change the fundamentals of your own financial plan. Remember, the goal of Invest Easy 101 is to give you clarity, not to sell you on complex schemes. The simple path, spending less than you earn, investing the difference consistently, and taking advantage of tax-deferred accounts remains the most reliable way to build a secure future. The rest is knowledge, helping you understand the landscape as you build your own journey, one step at a time. Thank you for learning with me today. If this deep dive into how wealth preservation works at the highest levels was helpful, please consider subscribing to Invest Easy 101. We're here to make the complex world of money clear and understandable, no matter where you're starting from.